from analysis and from the little situations, this is not always the case. Because if you have so many big banks, they still raises element of systemic risks. And what we usually talk about, too big to fail. So there are those people against these consolidations, and they argue it's better to have many banks in the sector. We don't have to create one humongous institution such that in case of a problem, we are not able to resolve this institution. And then the others talking about that it does not automatically translate that when you have a bigger institution, it raises what you call economies of scale. Others will have inefficiencies because of these big institutions. So there is an element of economies of scales. So those are some of the things that the policymakers or the empirical studies talking about against these policy-led consolidation. When we look in terms of the facts or in terms of numbers, we have three charts first. One, it is talking about the liquidity ratio. And you can see, on average, our banking sector are above the minimum requirement. The minimum requirement for liquidity ratio is 20. But you can see we have banks which have liquidity requirement even above 70%, meaning liquidity is not an issue. Though this one we have to interpolate in terms of even how we compute liquidity, because as part of our requirement, in case you have invested in government securities, even who are more than 1 year, they are still considered liquid assets in the assumptions that the government of Kenya cannot default. But all of us knows in situations like in what happened in Ghana, this may not all automatically happen. But for now, we are assuming that your liquid assets even include government securities which are even more than 1 year. The only problem now, even though we have all these liquidity ratios, you still have banks experiencing liquidity problem. Because if you look at the middle chart, it's talking about borrowing from central banks. You can see from 2014, the borrowing from central bank was somehow not significant, but it has significantly increased until 2023 to around 320 billion. So the big question asked, if the banks have all this liquidity, why are they still asking central bank to assist them with this liquidity support? And that explains that this liquidity that you are seeing may be concentrated in a few institutions, and the others are still having problem. And number two, because of these computations, the way we compute liquidity and where we have even long-term securities, it may explain that in little sense, the banks, they don't have enough liquidity, because unless you discount these securities, that's the only time you can realize real values to meet your day-to-day liquidity needs. And then lastly, in terms of the chart on the far end, we have tried to link the growth of assets with the growth of capital. Because ideally capital, the core capital is supposed somehow to track your expansion of loan book. And you can see for some times that have been happening from 2013, you can see the two charts are almost moving the same direction. But in 2021, you can see the diversion, whereby the core capital growth rate, it is declining, while the gross loans or the expansion of loan book is increasing, meaning there is what we call element of hardening risks. When also we look in terms of the concentration, we have the first chart whereby, we have three tables there. The first table talks about the minimum requirement in terms of capitalizations and what we have. And in terms of the numbers, on average, the sector is well capitalized because we are the CBK, the banking sector maintain capital even on top, above the above the CBK requirement, and at the same time above the Basel III. So in terms of the capitalization, we don't have an issue with that. So the biggest now question comes, if the numbers of capitalization is still high above the minimum requirement, and even look at the numbers, the total capital in the industry, which is around 874.9 billion, and when you do simple mathematics, if you assume each bank have a minimum capital of 1 billion, you can see in terms of quantum numbers, we are way beyond that. So it raises a question whether do we really need to increase the capital requirement if currently the banks are still maintaining that. But the question now comes to the issues of concentrations. If you look from 2003, that is almost 20 years ago, 2 decades ago, large tier banks were occupying over 80% of the market share, which somehow have declined to currently to around 76.6 in 20 years. Meaning, if we wait for the market to collect itself, maybe to move toward more perfect competition, it will take a lot of time, because for 20 years you can see we have only reduced by around 4% in terms of concentrations. And at the same time, when you look at the bigger indicators, you will see there are still elements of instability that are existing in the financial system, despite having high capitalization and liquidity. For example, if you look at the last, the credit to private sector, which is the third line from down, from 2006 the number were high, whereby meaning the banks were able to meet, they were able to fund the economy at 46%, which have, at private sector you can see it was around 12% in 2006, but it have reduced to 9% at 2021, meaning the banking sector is not able to intermediate enough and support the economy as expected. And number two, if you look at the profitability indicated by return on asset and return on equity, you can still stagnating, whereby from 2006 we used to have around 29% in terms of return on asset, so return on equity, which have declined to around 2021, which is around 22%. And you can see even in terms of non-performing loans, though in 2006 were high, 21%, but from 2017, you can see it have moved to double digit back to the original years, that is before 2006. So this provides a mixture of risks that we can see in the sector. Despite having high capitalizations, there are still elements of instability which are still there. So in terms of the expectations, the study wants to see, is capital a solution to addressing this problem instability at the same time in competitions? That's what we want to see. And since there is no clear linkages between capital and competitions, the paper wanted to see, can it provide empirical evidence to that? So I'll not bore you so much with in terms of empirics, but the paper have a detailed analysis of this. The only thing I'll mention is three key things. From the literature, the issues around the main key issues that comes out in terms of the relationship between these policy-led consolidations and issues to do with the stability and competitions is that the argument around what we call consolidation for value, whereby the bigger it creates synergy both for shareholders and at the same time the bank is able to solve what we call agency problems. They are able to create more value because there is a big enough, they are able to get more market. And they allowed, a second strat talks about the market power, whereby when we have a concentrated financial sector whereby we have a few institutions that are there, somehow they are able to collude. And when they collude, they enjoy what you call monopoly effect. They are able even to charge more income or more prices. So there are people who will talk about concentration because they want to see whether these collusions effect can affect them. And then the last one talk about differentiation efficiency, whereby more efficient institutions are able to acquire less efficient firms. So in terms of data and the results, we have used the panel analysis, and then we have constructed two indices, one to measure financial stability, that is financial stability index, and the other measure is in terms of competition measures where we have used the PANLO's H statistics, and we are using annual level data. So in terms of the variables, which I'll still not want to take you through, but the key point to note is that H statistics is usually liked because it's able to capture the input prices for different prices of either fund, labor, and capital. And when you do the sums of the coefficients of these input prices, you're able to get a coefficient, which we call the H statistics, that is used to measure the level of competition. And then because for stability is a dynamism thing, since you cannot have one indicator that shows that the banking sector is stable, we have tried to construct an index that uses different components of banking sector values, and then that's what we are showing there. So in terms of the model, let me jump model, and then I go in terms of the results. What is the data talking about? One, when you compute the bank sector stability index for the period that we are doing study, that is almost 20 years, the index, despite I have not indicated in terms of situations, it is able to explain the underlying situations that used to happen. For example, from 2002 until the global financial crisis 2008, the sector was generally stable, whereby we didn't experience majority of the issues because the banks were accumulating capital, or the policy reforms that were done in 1990s and 1980s, whereby we had a lot of consolidation of small banks. The sector was moving from the negative element, because in case the index is below 0, it means there are instability situations, and it moved up to stability situations from 2008. But you can see when the global financial crisis happened, we are not so much affected as our banking sector. However, around 2012, when we used to have what you call the exchange crisis, you can see the instability happened, whereby it moved from the stability region to instability region. But the key point is to concentrate at the far end, that is 2021 to 2023, and you can see the sector is somehow okay, whereby we are moving, we are growing in terms of long-term stability, in terms of the trend is moving upward, which is a good thing. But still we have this element of instability. And in terms of competition, which is explained by the results there, where we have computed what we call the H statistics, which I'll explain, it shows that is around 0.59, which means we are in what we call in monopolistic sector. So in terms of the final results, or what is the conclusion, is that from analysis, the data confirms that from capital perspective, the stability is not an issue. Is not an issue in the sense that long-term stability is there, despite some elements of or pockets of instabilities that are within individual institution. But on average, the banking sector is okay. And in terms of the competition, is that even previous studies confirmed that Kenya is still monopolistic in nature. And even this particular study confirms that we have not moved from this particular monopolistics, because when you do the H statistics, it's supposed to be 1 for you, at least you are saying you're in perfect competitions. And in case you are between 0 and 1, as long as you are moving toward 1, it means you are moving the correct competition situations. But the number still says that our sector is still dominated by few banks. So, in terms of whether capital, does it affect stability, and at the same time does it affect competitions, we use capital here, the core capital, which is the one that is usually changed by central banks in terms of the absolute numbers, and we saw that when you raise capital, it promotes competition. But when you raise capital in a significant manner, which we measured here by doubling the core capital in terms of you do square core capital, we show that in long term, higher raise in capital is reducing competition, in the sense that you are likely to have situations where there will be massive banks that will leave the sector, and it leads to few banks remaining. And this is the evidence with what happened in Nigeria when they had this significant increase in capital, which was intended to address the issues of competition and stability. But since the capital requirement was so big, it led to negative intention of raising the capital, which is still this particular data is talking about. However, in terms of stability, when you raise capital, automatically as expected, it is leading to more stability in the sector. So finally, the paper just recommends one, is that it is not automatic that once you raise capital, you'll be able to address our problems. That is competition and stability problem. Meaning we have to take appropriate capital regulations, whereby it should be not a block figure like the way we are talking about raising the capital by tenfold, because it may lead to some elements of inefficiency in the sector whereby we'll have many banks leaving, which raises still stability concern, and at the same time leading to coalition or concentration of few banks. And lastly, which is still okay, is that issues the macroeconomic instability such as inflation, just like in the previous paper, still is affecting the stability of the banking sector, meaning that as policymakers, you still have to take care of other issues apart from the capital, because instability is not only solved through capital raising, but also try to address the other issues of instability. Thank you so much.
Basically, this paper talks about capital, competition, and stability. And when I was reading this paper, I was reminded of a similar paper in 2012 that was actually presented here. And recently a paper by Jared, and I think it was on market power with, I think, David. So this paper basically delves into the relationship between competition, stability, and capital, and the role that capital plays in actually enforcing all these. So Daktari had two main observations, or two key objectives, which I actually changed them into four, because he's looking at the evolution of both competition, looking at the evolution of both stability, and also looking at how capital affects these two. So essentially, for me, when I was reading this paper, I divided them into four, because these are totally different things. And the beauty with this is when you read a paper by Stiglitz, he talks about too much competition causing too much instability, or too little can lead to inefficiency. So he talks about all these. And one of the papers that I came across when I was doing some reviews on this is a paper that was written in 2018 that actually talked about increasing competition, increasing stability, and how to improve efficiency in the banking sector. So that's how I found the importance of this paper in terms of all analyzing all these elements. And maybe I could require Daktari to look at these papers that I've actually mentioned here, because they talk about all these elements which were not actually encountered in the paper. So what is the relevance of this paper? Essentially, even before we go to the strengths and the areas of improvement, is this paper first looks at the regulatory environment. And the key thing with this is central bank is enforcing things to do with the capital requirements. And when you look at this, is the current discussion that is going around, and Dr. has mentioned to it, is the issue of the 10 billion capital requirement. And whether small banks will be able to adhere to these, or they'll have to merge with other banks, is another element. The other key element that we're looking at is the issue to do with financial stability. The reason why we are looking about capital is we want our financial system, our financial ecosystems to be stable, so that we don't go to the cases that were there a few years back in terms of Chase Bank or other banks. The other component is on market dynamics, because when you're looking at market dynamics, you're looking at are we a competitive financial market? Are we a monopolistic or oligopolistic kind of market? And so this paper is actually going to address most of these things. That's the relevance that we find in this paper and the current times. So the key findings which Dr. has alluded to is the four that I was talking about. The first is the 0.6 hedge statistics that he found, clearly indicating that a very few fraction of banks that are actually still controlling the market. And well, we have 37, almost 40 banks, but we have very few that are actually controlling the market. So we are in a competition that is called monopolistic competition. So we are not yet really competitive, not really monopolistic, but monopoly competition. Then in terms of stability, using the BSI, and I must commend Dr. for this, because most of the researchers in the market have not actually developed an index. We end up actually insisting on the Z score, but Z-score looks at an individual bank, but doesn't look at holistically the industry. So Daktari developed the bank stability index, which actually showing an upward trend in terms of the movement of our stability, as much as there were some elements or some years where instability was experienced. The other part that he found was, of course, the issue of what I will call diminishing effect or non-linear, because he talked about when you increase capital from when they're starting, it's actually creating a competitive market. But as you increase capital, the competition actually reduces. So kind of diminishing returns in terms of capital and competition. And then of course in terms of capital and stability, clearly we see that capital increases stability. So strengths of the paper actually captured in the comprehensive analysis that Daktari has put in, especially in terms of the introductory part and also the econometric framework that is actually put into this, the BSI, the H statistics, and also the econometric model that's actually employed. Then of course the literature is very rich. I found it to be very rich in terms of looking at competition in Kenya and also looking at other conflicting elements that we find. The context in which the paper was written was also good because it encompasses all elements of the banking sector, capital requirements, stability, and the requirements that actually central bank are putting in place. The context so was captured very well. And then of course the empirical contribution. What I found that we need to improve on the paper is a bit of the introduction should be streamlined, especially looking at the element of the 10 billion question. I think it could be captured a bit in the part of the introduction, as much as we might not capture it in the literature review, but at least in the part of the introduction, I found it to be very weak in terms of actually introducing the topic. And then some comparisons in terms of the empirical, I thought probably looking at the regional levels, maybe some improvements that have been happening. I think in Uganda, we have some improvements, I think in the banking sector in Rwanda, South Africa. So I think maybe in terms of just contributing to the comparison so that we can actually say, as a country, this is where we stand by in the banking sector, or this is where we stand by in the financial sector. Then in the methodology, I have some limitations with the H statistics, and there's some empirical literature that have been done around this, especially from 2018, 2020, which actually against, I don't know, it's a point of discussion, we could look at it, which are against making conclusions or recommendations based around the H statistics. So these are some of the things that we could check because of the weaknesses that it brings as much as it has some strengths. In terms of the discussion, I found the interpretation of the results about the relationships not being very clear in terms of, possibly I'll combine this with the recommendations, being too general, and I think we could improve on this because when you just talk about the uniqueness and challenges that are facing the country, I think we need to be very specific, considering that you're talking about competition, you're talking about stability, and how do you go about them. So I found this to be a bit general, and maybe we could improve on them. The other thing that I could look at is, of course, I've alluded to this, the issue of the 1 billion to the 10 billion. This could be included apparently in the styles fact. I've already talked about that. Then in the broader perspective, last week the Fed cut the interest rates. How do we find it? Maybe this could also be a general question even to the audience. How do you find it affecting the banking sector, for example, in Kenya? And if, although this was also a discussion yesterday, and Jared alluded to it, that not necessarily if the Fed interest rates are cut, then it means generally the MPC also will follow Q. So maybe to look at it in the global context, how will it affect Kenya? And then the issue maybe around fintechs. How does it affect the current situation in terms of capital requirements and also in competition, and also, for example, the tech companies like Safaricom and all those, in terms of eating into the banking sector market? Are we going to see maybe some mergers between these fintechs and banks, or banks buying into fintechs companies? So these are elements that I think could be brought into the paper if necessary, to see how they will impact the financial industry. And now, just to look at the hedge statistics, what I was talking about in terms of why it's not necessary, because when you look at it, a paper by Sanchez, maybe you could look at it, Daktari, it talks much about making decisions against using the hedge statistics for the government, which might not really come out clearly, because it doesn't capture the market dynamics, the hedge statistics, when you look at it. And so the recommendations that I had there is maybe to look at the most common market power, the Lena index, or a combination of both, because I know you've captured elements in the literature review to do with the structural and non-structural measures. But how about if you combine them? How will the results change in terms of making our decisions? So that's around the hedge statistic. So having said all this, I go to the policy implications that were made. And also, again, this is not just to the paper, but to the entire audience. With the findings of this paper, are we going, for example, to say most of the small, medium banks or the small banks will actually be merged, or will they be consolidated with the big banks in terms of looking at competition and also looking at stability? Does it entail that the policy that will follow, and then, especially in the wake of the 10 billion requirement, that these banks will go into it? Then the other element is to do with probably a caution on consolidation, and the paper has already spoken to it, although it was not captured in the main paper that I read, but I think this one came after. In terms of consolidation, should we move with caution? Are we going to create, because Daktari alluded to the too big to fail, and I'm thinking, if we say now the small banks are going to consolidate, is it a good thing or a bad thing? Are we going to see an excessive concentration in the market? Then the other thing that we need to look at is basically the market dynamics, that the paper should actually talk about the issues of assessments, or if it's needed or not, just to include in the part of the recommendations of the paper that I thought. So thank you very much.
Let me take this chance to thank Caspah. You really read the paper, and I really appreciate for that, because you have provided very comprehensive feedback, and even provided very strong foundations that I need to address. In terms of things that I have captured, I need to address is to provide, which is missing the paper, the experiences from the region, what happened to other comparators like Uganda, Tanzania, Nigeria, what is the experience, which is a key thing, which thank you for bringing that up. I'll try to make sure that the final paper provide that. And then also the exploring whether we can have different measures of competition to see whether they still produce the same results. So those are two key things which I've noted I need to implement to improve the paper. But there are still others which I've captured, and I know they'll be better. And thanks, Director, for also providing more clarity, especially along the issues of staggered increase in terms of capital, which I've not even indicated in the paper, whether what if we do a staggered linearization of this expected increase, will it still provide a more better, instead of bringing the disruption in the banking sector? So thank you so much, and I look forward, even myself, having the final paper which have more policy solutions, and a paper that is able to contribute to these very topical issues on stability, competition through use of capital. Asanteni sana.